morning, happy Sunday, and happy holidays from warm and foggy Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, December 15th, 2024. Our podcast theme today is, how did you do this year? With 2 weeks left in 2024, this will be our last Following the Money podcast until January. This is the time of the year that both professional and individual investors kind of take an inventory of how they've done over the past 12 months. And often will start to consider whether they need to acquire some different research or better research, or look for a better investment advisor. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005. So this is our 20th year. We are now also investing via our Asbury Research models and model portfolios for professional money managers, including RIAs, as a third-party money manager. So regardless if you're an individual investor that's managing your own accounts, or you're an RIA that's looking for better solutions to managing a portion of your total AUM, I hope you will consider us in 2025. Now let's get down to business and follow the money by seeing how our models and tools are currently positioned for the rest of this year and early into 2025, and to also take a look and see how we've done this year. With 2 weeks left in the year, our CEF model, the sector rotation model, and we're going to go to the CEF model right here, which is inside the research center, which is the paywall. And there it is right there. Our CEF model, it's up 25.4% for the year. It's trailing the S&P by about 1%, but with a 45% smaller maximum drawdown, a 35% lower beta, and a slightly lower standard deviation. What do those things mean? The best way to find out what they mean is to use Investopedia.com. We don't have any affiliation with them whatsoever, but it's a really solid business glossary for those that are involved in the financial markets. So this is Investopedia.com. We just basically went to search here, and this shows you what maximum drawdown is. You could also look at beta. You could look at just about any term that you could think of. But the maximum drawdown is from when you're looking at your P&L. It's where you peaked all the way down to your bottom. Or if you're looking at the S&P 500, where the peak in the S&P 500 was all the way down to the bottom, that's your maximum drawdown. So basically with 25.4%, we still got a couple of weeks left. We may be able to squeeze a little bit more outperformance from the markets here. But just as we sit now, we're up 25.4% for the year in CEF. And again, a 45% smaller maximum drawdown. What does that mean? That means, especially for older or more risk-averse investors, because with the S&P 500 up 49% since October of 2024, there's probably a very big and nasty market decline in our not too far in the future for us. And again, especially if you're older or you can't stomach the large drawdowns anymore, it's a real danger to consider. One that could quickly take back a lot of the profits that you made this year. So being able to, there's kind of this is a two-part equation. One is good performance, and we've had that this year. But the other part of that is keeping your drawdown smaller than the market. If you can get both of those things, that's kind of nirvana. Bigger picture, since inception in June of 2018, CEF has outperformed the S&P by 8.3% on an annualized basis. Let's have a look at that. So this is our own in-house table that we create for ourselves at the end of every year just to see how we're doing. So this is through the end of last week. Data goes through 12/12, and here is CEF here since inception. So we're looking at this kind of bottom right quartile here. You can see since inception in June of 2018, the S&P is up 13.17. CEF is up 21.47. It's called 21.5. So if you annualize this from June of 2018 through the end of last week, annualized, we're outperforming the S&P by 8.3%, with a 4.5% less right here where my mouse is, 4.5% less maximum drawdown, a slightly lower beta, and our standard deviation, which is right here, is effectively the same number. So CEF, interestingly, has also outperformed all four of the ETFs that we have found that utilize a similar sector rotation strategy. So we're going to look at that here. Here is CEF, and three of the four that, well, here are the four that we track. Actually, all four are here. And historically, you can see annualized total return for CEF is significantly higher than all of our peers, all the people that we would look out and see who's got an ETF like what we're doing, and how are we doing. That's how we grade ourselves. We want to see how we're doing versus the S&P and also how we're doing versus our peers, because this is a specific ETF, this is a specific trading model, CEF is, that is really specific to sector rotation. So meanwhile, let's go back real quick before we jump one more time. Let's go back and take a look and see what our signals are right now. So we're going to go back here to the CEF model, and we're going to see going into the end of the year, heading into next week. We generally don't show this every week because this is part of the paywall, but since we've only got a couple of weeks left and we're talking about how well we did this year, we thought we would give you the signals for this week. CEF is always invested in the top three, and the top three have the lowest scores. So this would show that consumer discretionary for this past week, which is our trading category in terms of time, it was the second best. In other words, the money was moving in there the second fastest according to our algorithm after XLC, which is communication services. Tactical, it was number one, which is monthly, and strategic, which is quarterly, it was also number one. So it had a score of 4. XLC had a score of 6, and then technology XLK had a score of 14. So we are invested equally in the top 3 sectors. The bottom 3 sectors right now are utilities, energy, and healthcare. Those are basically where the money is coming from. If you look at the S&P 500 into 11 slices of different shapes, for example, consumer discretionary, according to the sector spiders, is 7.8% of the whole. Technology is 23.7%, and so on. But if you're looking at this kind of holistically, the money is coming out of healthcare, energy, and utilities and going into XLY, XLC, and XLK. Meanwhile, our second model, our second kind of major model, or correction protection model, or CPM, which we're going to go to right here, we are currently on a risk-on status since August the 15th. CPM is up 25.2% through the end of last week for the year of 2024. Although it's trailing the S&P by about 3% year to date, it has, let's go back here and look at the stats again. Here we go. It's trailing by 3% year to date. Its maximum drawdown is 32% smaller than the S&P, 24% lower beta, and a 14% lower standard deviation. You could see those here. We'll look at the max drawdown of 8.5% for the S&P and only 5.8% for CPM. Now, since inception, which is really what we're most interested in, we want a model that's robust enough to work well over time. And this past 7 years, 6-7 years, has been a really a diverse chunk of data to look at. We've had a 100-year pandemic. We've had a switch from a zero interest rate policy to a more normal interest rate policy. We've had a Fed-induced crazy rally in 2021 after COVID, when the Fed came in to try to see if it could protect the economy the best it could. And then in 2022, we had a major downtrend for most of the year. So this has been a really good chunk of data for us to look at. But since inception, and here's CPM. Remember, CPM is a defensive model. CEF is an offensive model. So since Q4 of 2017, CPM's annualized performance right here, annualized total return, is effectively identical to the S&P 500. But look at the max drawdown. Only 20% for CPM versus 34% for the S&P 500. Standard deviation is almost 5% less in CPM, and the beta is 0.4% less, or 40% less than the S&P. So S&P performance for a lot less risk. The next thing I want to do is introduce something that we've just added. We've just added a new product to our low-cost entry-level research offering on Substack. It's called the Sort Report. So let's go back here to the internet, and here is our new offering. So this is Asbury Research Chart Focus. This is through Substack. It's very inexpensive. It's $25 a month. It does not include all of our models, but it does include, it's kind of an entry-level opportunity to get involved in the Asbury Research themes. Asbury Research's methodologies for investing. So our Sort Report is here. And this is weekly. It comes out every Monday. And what we do is we use our own internals, very similar to the stuff that we are looking at when we're looking at all of our models that are inside the premium research. Same themes, but now we're just making it a little bigger, a little more broad. What we're doing is we're looking at a total of 10 different asset classes, and we recently added crypto. So the next one of these that we publish, which is going to be tomorrow morning, you're going to see crypto in here. But what we do is we apply our own tools to these now 10 ETFs, and we have U.S. stocks in there, interest rates, commodities, emerging markets, the dollar, and of course, again, we're also adding cryptocurrency as of tomorrow morning. Each ETF is graded in 3 key criteria: trend, which is here; relative performance, which is here, and that's versus the S&P 500, and also money flows, which is here. We can make this bigger. There we go. The Sort Report allows users to quickly identify opportunities at a glance by focusing on ETFs with all 3 greens all the way across, indicating those major areas that we think are the strongest opportunities in the market. So right now, and this is about a week old, we had U.S. technology via the Qs, and we had global equities via SPDW, both the tickers for the ETFs there. So the second part of this that I also wanted to talk about is the chart focus. And for that, we're going to go, let's back up to Sort Report and then take a look at our chart focus. Chart focus is the part of the Substack offering that we initially offered maybe about 7 or 8 months ago. And what that is a weekly piece that comes out on Thursday or Friday, and that will look at whatever charts that we happen to think are important for that week. Here's one from 11/29. So we have a summary here. We have a strategy down here at the bottom, and then we have all these charts that maybe after looking at 100, 120 charts, these are the 9 that we think are the most important for you to pay attention to as we go into the new week. We have where the support is in the S&P 500. Chart patterns with targets. Here's one in the NASDAQ Composite Index. Here's our Asbury 6, which would have been current at the time of this report. We're looking at volatility. We're looking at AUM and various key ETFs and so forth. So just a little mention that I've been doing this for 40 years. We've had Asbury Research for 20 of those. We've been in business for 20 years with Asbury Research, and there is a certain amount, there's a certain demographic that doesn't want to buy into a much more comprehensive or bigger service, or maybe doesn't want money management for us. All they want is kind of a 32,000 foot taste of what we're doing and how, and as it pertains to our own approach to markets. So that's what this is. If you're interested, again, asburyresearch.substack.com, and you can click to subscribe for free, and you just get some bare bones. I think you get one chart a week, or you can also subscribe for $25 a week or $250 a year, and you can get both the 9-chart focus once a week, followed by the sort report, which shows you globally where the opportunities lie. Finally, let's look at tactical direction according to our Asbury 6. So we're going to go back to the premium research, which is inside the research center, and we're going to look at the Asbury 6. Asbury 6 has been doing something really unusual here for the past 2 days. It's equally balanced at 3 green constituents and 3 red ones. What does that mean? It means the market's in balance. And typically when the market comes into balance that way, it's kind of like a seesaw in a child's playground. When it reaches horizontal, it's getting ready to rock either one way or the other. That's where we are with the Asbury 6. The support level that we've attached to that is S&P 6,000. We're just above that now. So above 6,000, and this goes back to 4 or more green, the Asbury 6 that is positive. That should give us the Santa Claus rally that often we are looking for at the end of the year. However, if this turns 4 red or 5 red or more, and we break the 6,000 level in the S&P 500, that's going to be a very good indication for us that the market is a little bit overextended and we're ready to begin some kind of a corrective decline. So there it is. That wraps up Asbury Research's Following the Money podcast for this week and the last one for this year. Thank you for watching. We appreciate your viewership. Our next Following the Money podcast is tentatively scheduled for Sunday, January 5th, as we're going to be taking a little bit of time off for the holidays. Finally, we will be offering a limited amount of 10% discounts for our 3 and our 12-month subscriptions to the premium research, which I'm going to right now in the research center. It includes all of our models, a monthly live Zoom, which we call a teach-in, usually the first Saturday of the month. This sale, we do this every year. It's going to start on December the 21st, and it's going to run through the 31st. We only put aside a certain amount of subscriptions at this discounted rate. So again, the offer is going to end at midnight on December the 31st. If you'd like to get an early spot in line for this 10% discount before it officially becomes available on the 21st of the month, contact us via the contact tab right here and type Asbury 2025 in the text box, which is right down here at the bottom. Asbury 2025, and you'll get your place in line, and you will get an offer to be able to take advantage of this sale that we're going to be having here in just about a week. Hope to see you here again soon. Have a wonderful and safe holiday season, and don't forget to like and subscribe. Happy holidays, everyone.